Welcome once again to Retire Well with Kevin Bucher, financial advisor, one of the co-founders of Citizen Advisory Group. I'm your host, Spike Spangle. Kevin, it is great to see you as always. What's on your mind this week when it comes to retirement planning?
All right, we're going to talk about taxes today, Spike, but don't change the channel. We're going to make taxes maybe a little more fun and entertaining, and I recognize that not everybody has the same passion for taxes that I do, but we're going to talk about strategies to beat the tax man, and I think we can all get behind that.
Or I can get behind that. And what I've learned more and more about taxes, and it's a bit of a chess game, and there are things that we can do right now to get ahead, to try to get ourselves some tax-free income streams in retirement. So taxes can be exciting, folks. Stay with us. We're going to talk about tax planning with retirement strategies, but always know that you can always get your own retirement checkpoint review. You can call our phone number right here. We're going to continue to give it out throughout today's program, 866-630-1675. I even encourage you to do this right now. Look, I know most of you are watching TV with your cell phone in one of your hands, right? Open it up to the camera function right now. Point it at that QR code, the black and white box down there on the side of the screen. When you click on that, it's going to go over to our website, and you can learn more about Kevin and his entire team of financial advisors. You can also schedule your own appointment right there with the QR code. Kevin, let's hop into it. But before I even let you start talking about tax strategies in retirement, let's talk about it before we get there. We have been saving in retirement tax accounts, tax deferred accounts for the last 30 or 40 years for many people. How has this experiment been working out? When this started, I think, was the early 1980s, correct?
Yes. When the 401k was first came to fruition, and employers walked away from the responsibilities of the defined pension plan. So how is it working out? I would say it's a mixed bag. So, I think the premise for a lot of folks that they kind of took for granted maybe was that they'll be in a lower tax bracket when they get to retirement. So they'll take advantage of the tax deferred savings to be able to take the income deduction for their contribution and then have a lower tax rate later when they come to take it out. But in some cases, that isn't really how it's played out for some retirees, where they're not necessarily in a lower tax bracket. And I would suggest that we kind of need to know, we need to be able to evaluate what your tax situation is going to look like at retirement while we're making those decisions. Now, in today's world, we have a lot more choice and flexibility with where we put our savings. And one of the goals, and this is, I have the benefit of hindsight in working with many, many individuals as they've exited the workforce into retirement. So with that benefit of hindsight, I know that one of the priorities has to be having not just investment diversification, which gets a lot of attention, but we also have to have tax diversification so that when I get to retirement, I do have some tax-free or tax-advantaged places to be able to withdraw some funds from.
Okay, so the pitch has always been if you put money into your 401k at work or 457 or 453, you don't have to pay taxes on that right now. Right? So everybody wants to do that. When you go to your CPA, say, I want to pay as little in taxes this year as possible. So we do that then inside our tax-deferred retirement accounts. But the trick of it being, you said that a lot of folks think that we're going to be in a lower tax bracket when we get to our retirement years. Why is that? And is it still true today?
Well, everyone's situation is going to vary. And, I guess I would look at it from a slightly different lens of, where are you at today and how impactful is the tax deduction for you today? So, I like to use this example. I do a whole presentation around taxes, and I like to use this example for a younger worker that maybe is 30 years old. I think it's reasonable to assume that you're just getting started in your work career and you're probably going to advance over the course of your lifetime and have higher earnings as you get older. So when would it be more important for you to get an income tax deduction? When your income is low and you're in a lower tax bracket, or when your income is high and you're in the higher tax bracket? And obviously the answer to that is, I want to be able to take the income deduction when my income is up high. And then the second part of that story is, if I put money into a pre-taxed account when I'm 30 years old, I'm not allowed to access it in a qualified retirement account until 59 and a half years old without an IRS penalty. So if I put it into the pre-tax account as a 30-year-old, it's got a lot of time for investment growth. It's very reasonable to assume at a conservative rate of return that your money will double for you every 10 years. So if I put money in as a 30-year-old on the pre-tax status and I was able to take a deduction on that contribution, it's going to double for me about every 10 years. So that might be 4 or 5 doubles. So 10,000 becomes 20, 40, 80, 160,000 maybe by the time you get access to it. So I got an income deduction on the 10,000 I put in, but now I have to deal with 160,000 on the way out. So putting money into the pre-tax tax deferred status maybe isn't in the best interest when I'm a younger worker and I have all that time for my money to build.
Let's say, though, we don't have a time machine and we can't go back 20 or 30 years and change what we did. Let's say we're a 50-year-old worker, 55, 60, and we are now seeing that Roth 401k option inside our plan at work. Should we stop contributing to the tax-deferred account and start using the Roth? Should we do 50-50? Is it even worth it at this point to be able to start using it?
It is absolutely worth it to look at that option. And I mentioned it earlier that having some tax diversification is important. And you're right, the vehicle of the Roth 401k is a new option for today's workers that didn't exist maybe 5 to 10 years ago, but it's very common in today's plans. So ideally, we would have that time machine and be able to go backwards in time. But because we don't, even as a 50-year-old worker or a 55-year-old worker, to start to build that tax diversification is important. Because if we don't have that, what happens is when we go to retirement years and we need money from our investments, we only have a taxable place to take it from without that diversification. That can lead to tax shocks in retirement, where we moved into new tax brackets or trigger some of the hidden taxes that people maybe not be aware of.
And we're going to continue to talk about those. As we said, it's the exciting tax show today. We're going to talk about hidden taxes, taxes that you might not be aware of. Over 51% of Americans don't realize that Social Security is taxable at a certain threshold. Folks, we're going to continue to talk about solutions, but get your own retirement checkpoint review. It is complimentary from Kevin Bucher and the team here at Citizen Advisory Group. All you have to do is reach out to the phone number right here, 866-630-1675. More with Kevin when we get back right after this.
Whether it's time with your grandkids, travel, or finally doing what you've always wanted, retirement is about having the time to live life on your schedule. At Citizen Advisory Group, we build comprehensive retirement plans customized to your individual goals. Whether you're still preparing, taking your first steps, or have been on the path for years, our trusted and caring professionals are here to help you manage the risks and navigate the challenges on the road to your financial future. Citizen Advisory Group, your retirement journey begins here.
Welcome back to Retire Well with Kevin Bucher of Citizen Advisory Group. I'm your host, Spike Spangle, and today we're talking about tax solutions in retirement. Things that you can do to get yourself into a tax-free income stream, at least as much as possible. We were just talking about using a Roth 401k. Most folks out there, including myself, we've been saving in tax-deferred accounts, the regular 401k. Now we are seeing options of Roths. We're also hearing about Roth conversions. Can I do a Roth conversion on my 401k?
So as you're still working, conversion options are not really there. But if you have a Roth IRA account, that's where conversions are available, and that's just the process of moving a pre-taxed traditional IRA or 401k account if you've separated service, converting that to Roth accounts where it's now pre-tax. You do have to pay the tax when you do the conversion, so there's some pain involved, but it is a little bit of a challenge for individuals who are still working. It doesn't mean you can't do it, but it's going to be additional income on top of your wages. So it's likely that you're not going to do it at the most advantaged tax rates.
So there are a few different options right now. Is that if you're working currently, been saving in a tax-deferred account like a 401k, you can look to see if there is a Roth option, start making some contributions there. But it's also very likely, like many Americans who have been working for 20, 30 years, that you maybe have an old floating one or two or three that you've rolled into IRAs. Those are ones that you could do a Roth conversion on, correct?
Absolutely. We see that on a fairly regular basis where there's an old 401k account or an IRA account that came from a previous employer, and it might be just the right amount to do the Roth conversion, pay the tax on that account now, so that you have that tax-free place to go in retirement.
A question that I've received a lot as an educator going around and doing seminars myself, people will say, well, I'm 62, I'm 65, I'm not going to get much advantage by doing a Roth conversion right now. Would you agree or disagree with that? Because I'd like to throw in RMD, 3 letters.
Yeah, I would disagree with that.
Okay.
Now, there's not a universal answer to that question because, again, it is going to be very specific to the individual's retirement situation and their current tax situation. So there certainly is advantages to converting at any age of life if you can do it at the appropriate tax rates, because you do lose. The older you are, you lose the doubling factor that I described earlier.
Compound interest, sure.
The tax-free growth of the Roth, but it's still going to have some tax-free growth. It just isn't going to double for you as many times as you were as an earlier worker. But where it really comes into play is for what I would call the spending shocks of retirement, where your basic year, year over year, might have you in a very attractive tax rate. But there's going to be things that happen throughout the course of your retirement. And that could be something that you voluntarily choose to do, like a vacation. Or it could be you needed to replace your roof or your windows, and you need an extra distribution from your investment portfolio. And if you have to take that from a pre-tax, that could have consequences that you're unaware of. It could trigger more taxes on your Social Security. It could trigger taxes on your capital gains or qualified dividend interest. It could throw you into paying extra for your Medicare through what's called the income-related monthly adjustment amount. So we just have to understand that withdrawals from these pre-tax accounts for these spending shocks could have unintended consequences that we're not aware of. So where the Roth comes into play is we dealt with the tax already at the rates that we were in control of and comfortable with, and now we have this tax-advantaged or tax-free place to get the money we need for the windows, for the roof, for the vacation.
Nothing you ever read on the internet is wrong, but I've read this one in different feeds, and someone is saying, I can't contribute to a Roth 401k because I make too much money. Where does this thought come from?
Well, the thought comes from, there is phase-outs to making contributions into a Roth account, but it is not for the work-sponsored Roth account. So if your 401k plan or 403b plan has a Roth option, there is no income phase out for that. So you could certainly take advantage of that. But if you're contributing to a traditional IRA or Roth IRA, there is income limits to that. But that's only one way to get money into a Roth, is through contributions. The second way is through the conversions that we're talking about, and there's no limits on that. No income limits, no limits on how much you can convert.
You can take a $500,000, $1 million account. You can do 2 or 3 different accounts. Again, the pain is you have to pay the taxes.
Yes.
So you don't always suggest doing all of it at once anyways, correct?
No. Yes, it really comes back to controlling the tax bracket and converting at the lowest tax rates possible. So this is where retirement income planning ties into the tax planning. It's so important because we can look out into the future and know what your income is going to look like. Not to the T, but we have some expectations about your income and where it's going to come from. So we know what your future tax liability is. So if we can compare your future tax liability to your current tax liability, we can take advantage of the lowest rates possible for these conversions throughout the course of time.
So I'd like to ask you about this. We can maybe get started on it. We'll have to do a little bit more after the break. The difference between doing your taxes and tax planning for the future. There's preparation, there's planning. Again, I think most Americans, just like myself, for most of my life before I started in this industry, I go to my CPA and say, I want to pay as little in taxes this year as possible. And that's then how most CPAs operate, is doing that. What's your philosophy on tax planning for the future?
Yeah. So 2 very different things. Tax preparation, tax planning, two very different things. And we do both. So as a firm, we do tax returns. It's part of the practice. But tax planning is something different. And the differences are tax preparation, the doing of your tax return, is reactive work to a series of events that have already happened. So we're looking back at the last tax year. So think about when you did the tax return in April. You were actually doing 2022's tax return or the previous year's tax return. So you're looking in the rear view mirror of years that have already happened and calculating the tax return. Now there's hope that we can look to find maybe some little nuances to reduce the current year tax liability, but tax planning is bigger than that. Tax planning is now looking out over a period of many years or the rest of your lifetime and looking at different options that we have to reduce not just this year's tax liability, because by reducing this year's tax liability, we may be increasing future years' tax liability. So we need to look out over a period of many years and start to take the appropriate steps to reduce our long-term tax liability and get the tax man out of our pocket.
We're talking obviously about taxes today and retirement. We're going to go on a break here. Maybe you can explain to folks, though, how taxes fit into the entire retirement checkpoint review. It's not just taxes. We've talked about everything from income strategies on different programs and putting together the financial plan, but it's all of these different pieces. What is the checkpoint review to you?
Yes, so checkpoint review is comprehensive look at all the different areas of financial planning. We're going to look at investments. How much risk are you taking in your portfolio? How much do you stand to lose in a down market? We're going to look at your retirement income strategy. Do you have enough sustainable income to support your lifestyle? We're going to look at the tax strategy. How much of your hard-earned money are you going to keep throughout the course of your retirement? We're going to look at your risk management package and make sure that you have the insurance you need to protect you and your family at the lowest possible prices. And then we're going to look at your legacy and estate planning and make sure that your wishes are going to be carried out when you're no longer here, and that you have the proper legal documents in place to make sure that you're protected while you are.
Kevin, we're going to take a very short break. Folks, get started on your own retirement checkpoint review. Call 866-630-1675. When we come back, think about what you have in your own retirement accounts. Guess what? Not all of that money is yours. You have a partner in those accounts that you didn't even know of. More Retire Well with Kevin Bucher when we get back right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Retire Well with Kevin Bucher of Citizen Advisory Group right here in Ohio. We also know that we touch some of our clients and so forth in the Michigan area, but basically if you're seeing us on the airwaves today, Kevin and the team would love to be able to help you with your own retirement checkpoint review. 5 points of your retirement planning strategy. What we're focusing on today is more on taxes. I think as you said, so we've already talked about still working. We're kind of at our early retirement. We're going to have to, boy, we got about 8 minutes left in today's show, so we got a couple more areas to hit.
Yes, so we really kind of hit on the pre-retirement years in the previous segments here, but So we break the retirement section into two distinct phases when it comes to your taxes. So what I would call early retirement, when you first retire, and then late retirement, which begins at the age of 73. So 73 is a significant date as far as retirement planning and changes that might happen where required minimum distributions begin. And that is when you have forced withdrawals that are now required for you to take from your pre-taxed accounts. So prior to that kicking in these early retirement years, we have to be able to evaluate what does the early retirement tax liability look like compared to when these RMDs, required minimum distributions, kick in, so that we're making the right tax moves in these early retirement years.
Okay. Well, and the RMD is one of the reasons that we're bringing that up is because we talked about Roth conversions before. Are the Roth accounts subject to the RMDs?
Roth accounts have no mandatory distribution from them. So you're allowed to withdraw from a Roth, and the withdrawals from those accounts, as long as you've satisfied the proper withholding periods, the withdrawals from those accounts are going to be tax-free, both the growth and the investment that you made into the account, but no required minimum distribution from a Roth.
So this is one of those areas where you get to start controlling what you do or don't pay in taxes. So if you take the pain earlier, do either the Roth conversion or do the contributions and pay your taxes along the way, that you won't have to take out those RMDs, maybe not having to affect. You gave the acronym because you know the letters. I only know it as IRMA. Can you maybe explain again what IRMA is?
Yeah, so IRMA, it's not an X. It's not an X.
Yeah, or not Grandma IRMA.
Not Grandma
your
IRMA.
favorite
So
cake.
It's an adjustment to the cost of your Medicare benefits. So Medicare has two traditional parts, Part A and B. Part A is what you pay your FICA taxes for your whole working life. And as long as you've earned enough credits, and most people we meet with have, or your spouse even, you qualify for Part A without additional premiums. Part B, though, comes with a premium, and Part B covers the medical side of Medicare, and there's a premium associated with that, but it is income-based. So if your income hits certain tiers, there's additional penalties. They don't call them penalties, Spike. I shouldn't call it a penalty. It's an adjustment to the premium, and for me, you might as well call it a tax, because that's what it is. It's a tax against higher income earners. They don't get any additional Medicare benefits. It's the same Medicare program, but they pay additional premiums for it.
But by taking a look at these taxes, by what you're saying, doing the tax planning, not just preparing your taxes in April, but by sitting down with somebody, you can start to control your tax brackets. Because here's the other thing. I know you do lots of tax events. You probably open up with looking out at the audience and going, does anybody think taxes are going down in the near future? So here's a way that you can control it. We're in one of the lowest tax environments in history right now. You can control it by paying taxes in the next couple of years.
Yes, and this what I call the early retirement years is usually, not always, but usually they in a very attractive window to start doing some tax maneuvering. So it's likely that while you're working, your income is maybe too high for Roth conversions to make sense. It's likely that by the time you get to the required minimum distribution age that your income might be too high to do the Roth conversions. But in these early retirement years, we can control where our income is going to come from. Sometimes that leads to Social Security strategies where we're delaying benefits while we're handling the taxes from these pre-taxed accounts. So fitting that all together, looking at Roth conversion opportunities in those early retirement years is a great window. It's usually when we can do it at the most affordable tax rates. And you asked this question earlier, Spike, that generally we're not going to try to convert all of your money at one time. We're going to use the tax brackets to efficiently Roth convert your funds. The goal is not necessarily to Roth convert every single pre-tax dollar you have, because we don't necessarily need to. The rules already allow us to deduct away some of our income. But if I can deduct enough away to keep me in the lower tax brackets when the required minimums kick in, that's what we're trying to achieve.
Kevin, as a financial advisor, and as we wrap up today's program, I also want to ask you just a little bit taxes on late retirement and survivorship.
Yes.
What do you mean by those?
Well, and I'm going to actually skip, no pun intended, to the survivor, because it's so important that I want to make sure we adequately cover it on today's show. It's likely that for married couples that one of you will predecease the other. And when that happens, there will most likely be a loss of income to the household. So your income will likely come down. But it's also likely at that same time that you're going to potentially be paying more in taxes on that lower income, because you'll be moving from the joint tax return to the single filer tax return, which is essentially half of the bracket. You have half of the tax brackets to work with. So the question I would ask, is your income as a survivor going to be cut in half? If it's not going to be cut in half, and it's not generally cut in half, usually the survivor is going to need about 80% of the income that you needed as a couple. So you're going to have about 80% of the income as a survivor, but you only have 50% of the room in the 10% and 12% and 22% tax brackets. So your income is likely going to be lower as a survivor, but you're going to be paying more of your income away in taxes. So we have to have strategies earlier before we get there to deal with those taxes at the lower rates before the higher rates kick in.
And this is something that you want to get ahead of. And I know that, folks, taxes doesn't seem to be like it's a fun topic, but it takes a little bit of planning. And if you start to just see the forest within the trees, you can start to make some moves. And I'm telling, for me, it starts to get exciting. I see these moves and I'm like, oh, I want to do this now. I want to help other folks understand it. And this is what, because you do live events, you do this television program, and you sit down with folks every single day in the offices. I'm sure taxes are a point where somebody rolls their eyes, but you can actually make it pretty exciting.
Yeah, and we understand that we might have a certain passion for these topics of retirement that not everyone has that same passion for. Not everyone has signed up to be a tax law expert, to be an income strategy expert or an investment expert or understand all the insurance, and we certainly understand that as our firm. But we do what we do so that you can retire with the confidence that these important areas are being taken care of on your behalf. So I'm not suggesting that you have to run out and be a tax expert and understand the differences between Roth accounts and traditional accounts, but we're going to create a framework for you to come alongside of us and have these conversations so that you can understand and make informed decisions to beat the tax man and keep him out of your pocket in your retirement.
Of course, taxes will be part of the retirement checkpoint review, but it also includes what other 4 elements?
Investment planning, retirement income strategies, the glue that holds it all together, the tax strategies, the risk management of your insurance package, and the legacy and estate planning.
Kevin, thank you so much. And thank you all for watching the Retire Well program with Kevin Bucher of Citizen Advisory Group. Folks, get your own retirement checkpoint review. Yes, it will include your taxes, but also your investments, estate planning, everything that Kevin has talked about over the several weeks watching these programs. Call 866-630-1675. Thanks for watching. We'll be back next week.